Webinar, How to Maximize Small Multifamily ROI in 2018, an Investment and Finance Outlook, sponsored by Arbor Realty Trust and hosted by Multi-Housing News. I'm Suzanne Silverman, Editorial Director of Multi-Housing News. And our speakers today are Charles Ostroff, Senior Vice President of Agency Products, and Vincent Troisi, Origination Sales Associate, both with Arbor, and Jack Kern, Director of Research for Yardi Systems, Inc. If you have a question for the panel, just submit it on the screen at any time during the webinar, either in the question or the chat section, and they'll answer as many questions as they can during the discussion or in the Q&A session that follows. Now I'll turn things over to our panel.
Thank you, Susan. First of all, I'd like to welcome both Jack and Vince for joining me.
Thank you. Great to be here.
As part of the discussion, and of course, thank everybody else who's listening. Just a few notes as far as Arbor. Arbor's a direct lender. We're listed on the New York Stock Exchange. We have Fannie, Freddie capabilities as well as FHA. We do bridge financing. We will do some mezzanine financing and in certain circumstances do some pref equity. We've been a top 10 Fannie Mae lender for the last 10 years. Our specialty where our business has started, or as I say, our bread and butter, are small loans. Freddie Mac has had the small balance loan program for 2 years, and we have been the #1 lender for the last 2 years. And everyone else can probably see on the slide just our origination volume and our servicing volume in total. As I mentioned, we do Fannie, Freddie, FHA, bridge mezz, pref equity, CMBS, and I actually did forget our senior housing and healthcare lines. So I guess we're going to get into what is a small loan. Vince, you can break it up with me, or I could go through it. Yeah, how do you want to do it?
You go through it.
Sure. So we do have Fannie Mae capabilities as well as Freddie Mac. Fannie Mae is $3 million nationwide, up to $5 million in strong markets. Fannie Mae has recently introduced or rolled out their hybrid ARM product. Again, in the market, $3 million or less or $5 million or less. Properties have 5 to 50 units. And loan amounts, as I said, with the 5 on Freddie. Freddie actually will go up to $6 million in nationwide markets, up to 7.5 and strong. But there's certain caveats. The properties have to have 75 units and less, and they have to be in top and/or standard markets. Key stats we always talk about as it relates to a small balance loan. You have about $44 billion in multifamily. It's probably a quarter of it. Represents 65% of multifamily loans, meaning that the dollar amount seems less, but the percentage of loans, because they're smaller loans, need to do more. Anyway, it's a growing product. It's a product that has a lot of focus as it relates to the agencies, and as well as the fact that they're under the regulator looking to do the small loans. Arbor does small loans all over the country. What's highlighted in the dark green, meaning California, Texas, Florida, Georgia, and the state of New York, is probably where we do the most amount of our volumes. And also we do have offices in regional locations throughout the United States. So one of the things that we always talk about is the features of, who's renting, who's living in a small loan property. I feel like I'm doing all this talking, guys. It just seems like everything I'm front loaded here. But anyway, you do have younger renters that are renting in what we would consider small balance loan properties. Typically, what we have found is that the reason being is that these smaller properties actually have what would be considered more affordable rent. So it might be somebody who's just starting out, doesn't need or want those amenities. We've also seen, as everyone knows, is that, household formation has grown a little bit, but purchasing of homes to these younger households has not really been available. So we look at, in that 5 to 49 unit space about, who's married, who, single with children or households without children. As, we've mentioned, it's pretty much in these smaller properties, it's people without children versus a comparison of 50 plus units. It's more that have families with children. And again, you can see the age distribution and where the focus is.
Charles, I'm sure we have a number of people on the call that are interested in getting into the business and potentially financing their first transaction. What advice do you give people these days on how to get started in acquiring a property and financing one of the smaller transactions in anything in the greater New York area?
Well, what I always tell people is it's a simple philosophy. I say play in your own backyard. And what I mean by that is that, both the Fannie and the Freddie program look for you to be local. That if you're not local to your property, and I think Fannie Mae is 100 miles within, and Freddie I think is in the same type of staying locationally, meaning that understand where you are, make sure you've done your research. Net worth and liquidity are typically your net worth has to be equal to or greater than what the loan amount is, and your liquidity. Fannie's at a 9 month, Freddie, you're going to look at probably in that same range as far as what are my liquid or countable liquid assets post closing. The other thing is that if you've never done this before, I would say to pair with a strong local management company, or you don't know, there might be somebody within the jurisdiction that you can partner a JV with, and that's something else to do. You might walk into your first deals as an investor, or you might walk in as somebody else so you may not necessarily be the lead as far as, I'll say, to understand the business and figure things out. But research to me is always, which you would know about, Jack.
Right,
research is key. It's do your legwork, find a market, find where you want to be. And I tell people you can get in the car, you can drive, you can walk, you can start looking at different things, picking up the newspaper as far as what rents might be within that market itself, or you have a feeling what's a growing area, where it's happening. But again, there's always risks that are involved in investing in real estate, and people need to be very clear about that. Vince.
And guys, just to add to this chart while we have it on the screen, you see the age distribution and the high number for people 20 to 29 years old. I think some of that, and to give you a little insight on the multifamily market going forward, I think the rise in student debt is really preventing people from buying homes. And although wages are going up, the rent growth in these cities has really outpaced the wage growth. So I do see the future for multifamily.
And Charles, a lot of your clients have been buying properties now for the past 5 to 10 years and are staring down the barrel of some expirations on their current transaction situations. What do you recommend looking into 2018 that people do? How far in advance should they contact you? What should they be thinking about when those loans are going to come due?
Well, it depends on the loan. Some loans do have a level of prepayment. It depends on, does it make sense, and what are my cost savings going to be, meaning that what was my rate then versus my rate now? What could be my prepayment? A lot of the loans that we have, some loans that we have, is you might have a within 12-month period of time or a 6-month period of time what we consider your open or non-prepayment penalty time. So you're going to have to either equate, if I have that good of a rate, I might want to do it early and running my models, or I would be contacting us a year in advance and say, hey, listen, this is what I'm contemplating, this is where I'm going, this is my open period, because this way we can underwrite a deal, we can do all the appraisals, the engineering reports, or site visits on a refi of something existing in our portfolio, and literally the day that it's open, if you want to do it without a prepayment, we're ready to close on that date. So we do that with an advance. I mean, as us as a company, it's interesting, as far as from a refinance perspective on what we have in our portfolio, we go 36 months out. We're starting to track and trend properties at 36 months out, and we're looking at their current interest rate versus what the rate they could get today, what their prepayment penalty would be. Some of the programs within Fannie Mae itself has what they call a choice refi, where you can bring in the fee down depending on how the property's operating and at what point they did finance the property.
For both of you, thinking about 2018 coming up, could you sum up what is essentially the good news on the horizon relative to what seem to be rising interest rates? What should people be expecting in the next year?
I think there's going to be a rise in interest rates, but I still believe we're going to be at historically low interest rates, that the numbers are still comparatively to historically where they've been, you're still going to be at a low level. All right, let's skip the slide. So anyway, you can see historically where, I guess this is going back to 01, it looks like.
Yes.
The interest rates. But anyway, I still believe we're going to be historically low. I also believe there's going to be a demand. I also believe, depending upon what sector you're in of the multifamily space, meaning that am I an A owner or a B owner or a C owner, and that's just from an asset. It might not be saying C is a low quality asset. It just might not be. It might be under amenitized and fall into that C class. What I tell people is that no one's building C product, no one's building B, C product. Within this industry, everyone's building A product. So if there's going to be an issue or an overhang of inventory, it's going to be in that A product space. So, again, value add. Very big believer in value add, big believer in renovating projects, big believer, again, depending upon the market, but you also have to know what you're doing.
Let's get into some of the economics as it affects the decisions that I think people would like to make. This is a chart that talks about employment growth by state on a percentage year-over-year basis by the Bureau of Labor Statistics. It's interesting for a couple of reasons. The first of which is Fannie and Freddie also get these charts. So there isn't a whole lot that happens in commercial real estate and economics that the agencies aren't looking at. And Charles, I would imagine that if we look at the growth rate in some of these, I don't know if those of you watching this on your screens can see the shading between the dark green and where it then jumps all the way down to the red. But fundamentally, you can see some markets. Do the agencies do any kind of redlining in any of these markets? Or
Redlining, there's no such thing as redlining. Redlining is probably an awful term, probably a term that we should not be discussing. What it is that typically an agency will, what we call, it's a pre-review market. And more likely than not, it could be for economic reasons, like Detroit. Detroit, when the auto industry was going sideways, there was questions of what was going on, so it was deals that they would want to go see, that they were going to go limit the leverage. Then there's other places, jurisdictions, I believe like Houston, like Oklahoma City, where they have a high percentage of the multifamilies on their books. So now it's something they want to limit what they're doing. So, okay, fine, we're willing to take the risk, but we're going to limit our leverage, we're going to increase the debt service coverage. So there's different issues that might go. When North Dakota, when the oil boom was going out there, and all of a sudden people were getting $3,500 for a one bedroom, but your cap rate was at a 15 on the property, they wanted to look at the property, because even though the mission statement is safe, affordable housing, put money out on the street, make sure there's liquidity, capital is in the market, there's still risk involved. It's not an open checkbook, we're going to take any risk. They have to be smart about how they're deploying the money and deploying it properly.
An interesting element to these employment slides is that the Bureau of Labor Statistics does a lot of revision to these basically 4 times a year. So consequently, the changes aren't huge in most instances, but it does demonstrate that if you're using this to make a strategy decision, you're best to look at a long-term trend line as opposed to an individual go state by state or metro by metro. If you go to the next slide. When you start to think about home ownership and the change in the percentage of home ownership, I think there's 2 key things here that are particularly interesting. It's true that there's been a significant decline in home ownership over time. Not, to be honest, terribly unexpected in many respects, but it's also true that the home ownership numbers are predicated by the Bureau of Labor Statistics housing branch on doing what is a fairly detailed sampling. And the sampling itself, when it's subject to a great deal of benchmarking, changes an awful lot. What we're seeing here is that we're not going to go all the way down to 60% home ownership, which is what Sam Zell noticeably forecast a number of years ago, but we are going to stay probably in the 60s for quite some time to come. There is an argument to be suggested for whether or not a higher level of home ownership means a higher level of economic prosperity, and whether in terms of ownership and certainly in terms of headship for renters, it's going to make a whole lot of difference going forward. And I think the answer to that is home ownership is generally within 5 to 6 percentage points about where you would want it to be in a healthy economy. And what I often tell groups when I'm talking to those that are investing in renters is that you need a healthy home ownership program to have a healthy rentership program, because that's what keeps money moving through the economy, and that's what allows us to have GDP growth as well as wage inflation. On the next slide, we're going to talk a little bit about student loans. This is an interesting area for a number of reasons. The first of which is there's 2 really solid sides to the discussion. One of which is if people have heavy-duty student loans, they can't qualify to get a mortgage, followed by a lot of the mortgage companies saying, well, that isn't always true, because in many instances, the home ownership rate and the student loans outstanding, as well as the amount of income that somebody has, will qualify them to be able to buy a house because they own student loans of less than $15,000 or $20,000 compared to those that are in the professional schools that have quite a bit more. So while it's true that student loan origination is pretty high, and it's true that an awful lot of these people decided to stay home or live in group quarters because they couldn't afford to be out on their own and they're trying to save money to pay all of this off, it has seemed to be more of a deterrent for people buying houses because of the performance of the asset over the past 10 years than the fact that student loans have been an absolute. Rather, I like to think about it in terms of the fact that it is a negative in a lot of ways for somebody to want to try to qualify for a loan. It's just one more thing you have to pay for, and you would then need to have the substitution effect. You're probably not going to drive the car you want to drive, and you may need to live closer to a bus line to save money so that you can pay your student loan and be in a house.
But also, with everyone starting out, it's also a matter of, I'll call it accumulation of wealth. You're still, aside from, an FHA mortgage, you're still going to need to come with a down payment. So if I'm paying my debt, and I have all these responsibilities, and I'm sort of at the beginning of my career or whatever else I'm doing, to get that 20% down, say, a lot of people still think that way, still think I need, they may not be educated on what kind of other programs are out there. They're thinking I need a 20% down. The other piece is what we have found, even from an employment perspective, is that the generation that I say that might be, 22 to 28, they're very mobile in a job. They'll leave for $1,000. So in this case, I call it a very mobile economy, meaning that they want to literally be able to get in and out of a place that they're at. And this way, renting an apartment, I'm not tied to it. I can go to another job. I can, change my careers. I can do something else. So there's not that root. There's not that, as I say, the white picket fence of an American dream anymore.
If you're an investor and you're buying either mixed use or you're buying potentially some small or even larger scale multi-housing, this is your decade. You've got to feel like things could not possibly get better, because the reality is renting is going to continue to be a critical part of the American economy going forward for quite some time to come. And sure, it'll have its ups and downs, and there'll be times where rent growth is going to be a lot stronger than others, but the long-term outlook, the picture for this continues to be really positive for owners, and in some respects, even a little bit positive for people that are renters, because those massive increases that you've seen in rent in a lot of places are moderating back down towards things that are basically inflation plus rent increases in a variety of areas. And the news that you've seen in a lot of outlets where people are spending up to 50% of their income on rent is going to moderate back down to a lower number that'll probably vacillate between 35 and 45 in the most immediate future. If we start thinking about wage growth, you can look at this two ways, one of which is what is wage growth relative to the way that the BEA will calculate it, and then the other issue is what's wage growth, real wage growth in terms of what's perceived to be inflation. Inflation is something that's in the media an awful lot, but it's really not very well understood by the economic reporters. Fundamentally, the CPI, which is the most common measure of inflation, about 29% of the CPI is a housing measure. So if you look at what is the inflation number and you take out of that what the housing metric is, inflation's really critically low and probably will not meet Fed targets for a pretty significant period of time, which means that wage growth that could be something above 2% actually represents a real gain for somebody who has a stable housing cost. And they can even have a stable renting cost. It would be almost the same thing. It's likely, given the nature of the recovery in the economy, barring obviously anything that could happen that's unforeseen, that we're going to continue to see stronger wage growth going forward. But there's also a couple of things to think about that I think are really amazing in terms of economic growth. The first of which is most of the people that stayed at their jobs because they couldn't afford to retire, a lot of them are getting to that age where they really do have to retire. They really don't want to or can't work anymore, so they are opening up slots in companies so that people younger than they are, that were previously underemployed relative to what those people were earning, are now going to be able to get better jobs, and people that were unemployed or employed in jobs having nothing to do with what their professional credentials would suggest, for the first time, we're going to have a plethora of openings that they never had before, which shows stronger levels of people moving into higher wage jobs, which shows more spending in the economy and greater growth going forward. So that wage growth number will continue to gradually climb over the next 10 years to a more sustainable level, something under 3%, and something to feel that it will justify more growth and spending in the economy. Now, jumping on to historical rent growth and affordability, I'm concerned about affordability, I think, as much as a lot of the other national associations in Washington are. That, in fact, what's been happening is that some of the wage growth hasn't affected everybody that we would like it to have affected. Some of the rents, as well as costs of construction, costs of land and entitlements, have gone up pretty dramatically in a lot of places. And in conversations I've had recently with a number of builders, and they said to me, even if you give us the land for free, we still can't build at a number that allows us to do anything about affordability. That's how high material costs are right now, in addition to labor costs. And it's going to be up to some community between the private sector and the public sector to figure out what to do about this. I don't have any answers to offer you today, except it's something to keep in mind going forward as you look at projects, that there are some special programs available for people that are building highly affordable, but they're not always programs that work out well in terms of specific areas or in terms of specific property types.
I just think, you know, with probably most of the people that we have on this phone, it's you know, they're in the profit world. They're not necessarily, not everybody on the phone is in the affordable world, and that, you know, as we discuss with a lot of people, is that if I want to go in and renovate a property, I'm going to want to get max rents. And without any level of incentive, subsidy, anything else, you're in the profit business. You're in the business of maximizing your dollars, and it may not even be your dollars. It might be your investors' dollars that you have to answer to. And I agree with you, Jack, as it relates to programmatically what's out there. I mean, historically, there's always been the low-income housing tax credit program, and I think with the uncertainty of what's going on with the tax code, I think there's been a slow-up as it relates to investors in the tax credits, that the pricing on some of the projects that actually hadn't syndicated their tax credits yet, the pricing sort of dropped versus what they had calculated to build out the project. I mean, personally, you know, I think the tax credit program is a very good program. I think it also fuels almost every other affordable program there is out there, whether it's public-private funding, whether it's the Section 8 on the deals, or whether it's, you know, community block development grants. You know, it's a way to, if you want to say, build housing, to sell that level of equity to where that you're not necessarily worried so much about how much is each unit going to cost me. And again, without that drive and with the uncertainty within what's going to go on in the future, it really is the only spot. So I agree with you that affordability is a big question. It's a big concern. It's something that's in the news all the time. I mean, California in and of itself is trying to put forth state legislation. And I think I had this discussion the other day that a lot of this the affordability issues are going to be thrown back onto the states. And the states might be put in that position where they have to set up some level of, I'll use subsidy program, even though I don't mean subsidy, incentivize owners who are either going to build or renovate, whether it's, you know, low leverage, anything else. But again, I get off subject for a little bit, but at the end of the day, you know, everyone on this phone, I would think, is pretty much in the profit world.
You know, when you're looking at this rental affordability chart, it shows the share of income spent on rent payments for all residential types. But this really gives you a pretty good indication, to be honest, if you're thinking about pricing power for rental investments. Because fundamentally, for example, if you think about whether it's an A, B, or a C unit, if you think about whether or not it's one that's institutionally owned or owned by a family trust, if you think about those that are in urban or interurban areas, this line would begin to separate in lots of different directions. And in fact, some of the REITs have been quoted as saying, rental affordability, what problem? We don't have a problem. Most of our residents are only spending 20 or 25% of their income on most of our properties. Well, for REITs, that's probably true, because remember, most of the people renting in REITs in highly dense areas are very high income earners, and it's probably not an issue. But the vast majority of other renters in a variety of other places probably aren't the same profile. So those that are skewing at 30% or higher for the most part are those that are going to end up being in different kinds of apartments in different sorts of locations. And this gives you a sense, as you see the change over time, and why pricing power has moved the way that it has, and the effect that it's had in people relocating from one location to another, or people making investments in one kind or another.
And I think that the senior space, probably those that are in fixed income, you probably see at a higher percentage.
I think that's right. Now let's talk about interest rates, everybody's favorite subject. So the first question that always comes up, I get a lot of calls from people, and they want to know, what are interest rates going to do? And I think I'm safe in saying what I heard a couple of weeks ago at the National Association for Business Economists. We were very pleased to have Janet Yellen come speak to us. There was about 1,000 of us at the event. And she was talking about Fed policy and the things that they were doing and the way that they make decisions going forward. Obviously, because it's the Fed and because of the blackout period, she couldn't stand up and say, this is exactly what we're going to do. But like every other Fed chairman, there were certain hints in the text of the things that she was talking about. And she fundamentally said that as the economy demonstrates sufficient strength to justify it, interest rates are inevitably going to rise. She also felt that in as much as significant parts of the economy are showing moderation, that would probably mean that any actions that the Fed would take translated mean into, if interest rates are going to rise, it's going to be fairly slowly. And if we're talking about interest rates that are maybe 25 basis points or so, even if we got 2 or 3 increases in a year, it wouldn't have that much of a dramatic difference. When we start getting to what happened to us in prior inflationary periods, which we don't have at the moment, interest rates tended to go up a lot. That's not true at this particular moment. And in evaluating the change in interest rates over time, especially the spread and the likely behavior of the Treasury, the way that we have the spread right now, even though it's narrowed a little bit recently, it's not likely to change a whole lot, and interest rates probably aren't going to creep up enough to make all that much difference. Charles, I know that that's probably the first question where people say to you, what interest rates can they expect and what's going to happen to my property? So what do you think?
You know, it's a scenario where, as I said, you're still at a historically low level, so you're going to see some upward movement. Most of the 10-year product that we do is tied to the 10-year Treasury. So, and you've seen that 10-year Treasury. I'm trying to think, was it at what point, at what time it was like, what, 130 or 140 it had dropped to, and then all of a sudden we shot back up, and now, I think we regulate. We get to a point of what's the new, meaning that all of a sudden there's a little bit of culture shock as it relates to a little bit of increase in the 10-year, and then we level off, and then everyone sort of sits on the sideline, what's going to happen, and then, okay, this is where I am, they jump back in, they see it dropping, they jump back in, they see it rising, they jump back in. It's a matter of when you have some level of stability, you have level of stability, people may not necessarily be in such a big rush. But I still think from a perspective of term, we're going to be historically low.
Charles, if we were in the room with all of the people on our call today, I would say to them, those of you that have been through more than one cycle, raise your hand. And I think most of you listening understand that there's an awful lot of people in this industry that haven't been through more than one cycle. So to them, what's happening now with interest rates and what's happening with the way that a lot of the financing works seems to be the new normal. Those of us that have been through a bunch of cycles, going back a lot of years, including the old days when the government handed out buttons that said WIN, with inflation now, and interest rates that went up close to 30% and things like that. I mean, we know that there is a certain variability in how this can work, and I would tell you over a long period of time that this is not the new normal, and that it's going to revert back to something a little closer to what Charles and I would probably anticipate being a new normal, and I think Charles would be pleased to weigh in on what he thinks that likely scenario could be, and if there's a time horizon that we would feel comfortable with.
I mean, if I had that crystal ball, right?
I'm writing it down now.
Exactly. But I mean, it's not. I don't see a sharp rise unless there's a world event. If there's a world event that jitters in the market, then all bets are off the table. Right now, we're at as you said, we're at a sort of the economy is still, in my mind, defying logic as it relates to the indices and the markets and everything else. So there is a level of confidence of what's going on. And again, from a housing perspective, it's a matter of people need places to live, and we're seeing, again, we talked about the homeownership. The other thing is, the U.S. Treasuries, everything else, Italy, Greece, Spain, instability. If anything, money's coming to the United States to invest in real estate. So with that, there's that vision of stability within the United States. It's going to translate into our indices. And with that, creates that level of stability. If there's going to be any upward, the upward is going to be, if you want to say from, even though we run on the bonds, the Fed talking about increasing. So different pieces here, there that will move it up. And then the other, as I said, I don't know from a world event standpoint. That's typically where you see, your greatest rise or greatest drop.
I think next what we'd like to do is answer the question, now that you've got a portfolio and you're trying to determine what options do you have and what can you do next, we're going to talk about small loan program highlights.
Talk about this. This is Vincent Troisi. I am a originator here. Just going over some of the advantages, particularly in Arbor's small loan program over a bank or a credit union. We can offer non-recourse. That's very attractive to a lot of first-time borrowers who are not sure where the market's going to go or how the property might be performing, but we can't go after any of your personal assets if the loan were to default. With our small loan programs, we can offer prepayment flexibility. We can offer yield maintenance if you're looking to buy and hold a property, or we can offer a declining prepayment penalty throughout the loan. We can offer interest only, reduced fees, application fees, and expedited processing. And a little later, we will go through our online platform. It's called Arbor Loan Express, and just walk you through that.
Excellent.
Charles, if you wanted to run through the 7/6 ARM product in this next case study. Well, the 7/6 ARM product is a Fannie Mae product, and it's a variable rate product with a 1-year lockout and then a 1% prepay after your 1-year lockout period.
Could you explain to some people on the call what those things mean?
As far
Well,
as
some people who are new to wanting to be invested may not be familiar with lockouts and prepayments, and just a rough definition for them about what they can expect that to mean.
Sure. I mean, the prepayment is we make a loan, we anticipate a certain return. And with that, there is a level of prepayment, meaning that there's a period of time, like on the 7/6 ARM, you have a 1-year lockout. Lockout means that there's no availability to prepay that loan. So after that period where you're locked out on this variable rate product, you would have to pay a 1% prepayment penalty on what the loan amount was. And then this way you can refinance somewhere else. A lot of borrowers that we have done business with like this variable rate product because they might walk into a property, they might be purchasing it, and then there might be upside to the property. And it might not necessarily fit in a traditional bridge loan space. So what they'll do is they'll come to us, they'll get the 7/6 ARM product. They'll do an in-place rehab or adjust tenancy to that, as they raise rents, or tenants to be moving out, they can decide to keep units vacant for a period of time, and then there's increased NOI, or they're increasing the rents, or they build efficiencies because they have a large quantity of units there, they know how to operate where they may have bought from a mom and pop. So now I've gone my 1-year period of time, I've gone through my lockout, I've done some level of renovation, re-tenanting, I've raised my rents, and now I can show you through my collection, through my pro formas, that this is where my NOI is. So what they'll do is now I have my 1% prepayment, they'll come to me for refinancing. They'll almost use this product as a bridge product, to bridge them to, if you want to say, permanent financing. In this case, it's easy enough. Somebody came to us under this. They were able to use the 7/6 ARM to help them to get a cash out. And again, a matter of going into it, doing the work I needed to do, stabilizing the deal, coming for another level of refinancing, and then able to walk with that $1.4 million. And a lot of times, a lot of the people that we see, they're not just doing it to put the money in their pocket, they're doing it to deploy capital in other places, or recapitalize on the property. And I think we have another case study that Vince might want to touch upon that actually enabled through the SBL program a borrower to deploy a lot of capital.
Right. So in this particular case, as mentioned in the previous slide, borrowers can use the cash out financing to do a number of different things. They can reinvest into the property through renovations. They can recoup some equity or pay off investors, or they can use it to expand their portfolio. In this particular case, you can see 42 units in Portland, Oregon. Borrower had a $1.5 million cash out and parlayed it into 3 different purchases, I believe 3 in Portland, yep. So as you can see, once you get that first one under your belt and you're able to pull out some money, it gives you a number of different options to go from there.
All right, I know actually there were a few questions as it related of okay, how do I get started, or how could I show you a deal that might interest you in providing the financing for? And it's simple enough as rent roll, historical operating, financial statements, your own real estate schedule, synopsis of the property, if it's a purchase and sale versus refinance, purchase and sale agreement, and what the cost basis is and the length of ownership. And one of the other things that I tell people is that within that synopsis, if you've done any upgrades to the property, if it's a refinance, you should probably outline that, where you spent your money, how you spent it, and how much you did spend. Again, advice for getting started is something we touched upon. Actually, we're here as professionals. You might come to us and say, I want this type of loan under these terms. There's times that we guide our clients, our borrowers, to say, something, I understand what you want, but you might want to look at this. So we're going to give you different options. It's not necessarily that, we're just a one type of product shop. Again, we have different lines of business. We have different lending partners. And within each one of those, there's different products available that will meet everyone's needs. And again, actually, these are all things that we just talked about when Jack had his question. So
I would emphasize a couple of things, too, one of which is get to know your loan officer at Arbor, sometimes well in advance of when you've got something you want to do. The more they know who you are and the more they understand what you have in mind, the greater the chances are that it's going to end up giving you the option to be able to consider a variety of programs that are a fit. The second thing is when you're evaluating a property, one thing I always like to tell people is if you're going to buy a property, what are you going to do that's different than the person you're buying it from, and what's the story? Because your loan officer is going to say to you, tell me about the property. And certainly the information you're providing is extremely useful to determine the way in which it should be underwritten. But there may be other characteristics that go with the story that's going to help everybody understand something that could trigger some ideas that will be immensely beneficial to you. And it's all about frequent and valuable communication with your Arbor loan officer to make sure that you're giving them everything they need to be able to move forward.
And one of the things that, Jack touched upon as far as the underwriting, the due diligence, for every deal we get an engineering report, an appraisal, and we inspect every property that we do a loan on. So what I explain to people in circumstance situations is that sometimes things don't look good on paper, but when you actually go out, you meet with who the borrower is, you shake their hand, you look them in the eyes, and you walk the property in the neighborhood, then there could be a better story there.
Okay, moving on to rent growth. Here we go. Next slide. Okay, so this is rent growth in major areas. The first column is the average rent for a number of cities. The second column is the year-over-year rent growth. This is prepared by my buddy Doug Wessler at Yardi Matrix. Shout out to Doug. The guy does an amazing job with his team putting together all these things for us. And I think I owe him a bet on this one. Charles, you guys do business nationally. What's your initial reaction when you look at changes in these markets over time? Especially from the perspective of what you think the agencies are thinking when they're evaluating these kinds of shifts in rent.
There's always that level of caution of when it's going to stop, meaning that have I peaked out, where am I at? But as you can see, these are major cost centers. I would say these are metropolitan areas that have a lot of employment, that have a lot of things going on. I would say in the past, in some markets like Houston or even in Atlanta, that there wasn't any level of diversification in their economies. Now there is diversification, and you're a little more settled in lending in those markets because of the fact that if before in Houston, as you know, everything revolved around oil. Well, they have shipping now with the way that they also have a financial sector. They have a medical sector. Atlanta, the same thing. There's a medical sector. I think they were very reliant on the airline industries for a period of time. You have technology, the same thing. So there's a diversification going on within these markets. I always, when I look at these lists, there's a few places that I always, always laugh about that as far as like Dallas. I always call Dallas a steady Eddie. That Dallas, you never really see a huge spike up and a huge spike down. You sort of get your bumps, you're here, there, or everything else. Portland as a city, the interesting about Portland is that supply. So Portland is a very difficult place to build in. So you're not necessarily like you would see in Washington, D.C. going on, where all the cranes are up and going on. You're not going to see that increase in inventory in Portland. Portland also has all these little neighborhoods where you have a lot of 20-unit deals. And I always tell the story as far as with Portland is that every appraisal I ever read talked about Portland as a city, 2%, 3% vacancy. And I never believed it. So I had to get on a plane and go visit with a few people and actually see it. And then, I laugh about, the other one I laugh about is Seattle. I call Seattle is my red wine market, and because one day you read that red wine's not good for you, and the next day you read that red wine's the best thing for you. So
can I use that? I
yeah,
like that.
we can definitely use that. And again, Denver's another area that has diversified. Washington, D.C. is an area, even though there's the government that's going on, and there's all the contracting and everything else, heavily reliant upon government. And again, you talk about the new administration going there, even though I'm not going to talk politics, is they talk about downsizing government. Well, how's that going to affect the consultancy business? We can have more consultants, we can have less consultants. How's that going to work? But also, if you go to D.C., like if you drive to Miami, there are cranes everywhere. So who's moving into these units? And those are some of the things that you need to think about. But from a perspective and a focus of what we're talking about, again, some of these markets are great markets to find a 10-unit or 20-unit deal, because in a sense you're under that radar. Again, as we talked about, these smaller properties are a linchpin of what's going on, because they create some level of affordability, because they're not as amenitized. They technically should be less expensive to run, even though people talk economy of scale, but you don't necessarily have to have somebody on site, open leasing office, things of that nature, but you need to walk your property. You need to be at your property, you need to know what's going on. They're not going to run themselves.
If we take a look at top multifamily markets, see any surprises?
No, of course.
There's a story behind every one of these, why they kind of jumped up on the list. But even to me, there are some places on here, Reno, for example, Eugene, Tri-Cities, that were a bit of a surprise, Central Valley, that I think it's a consequence of some of the shift in employment, and also some of the growth maybe due to mining and minerals, maybe due to manufacturing.
But it's also, like you say, with you read in Reno, is that the Silicon Valley's gotten so expensive that some of these companies have looked for offshoots or regional places to where they can provide, they can go. It's cheap for them to operate, that they don't have to pay the salaries that they need to pay to, that quality of life of the people that are working within of what they're doing. So you have to look at it that nature also, is that some of these places also, Eugene, Oregon is beautiful. You have the University of Oregon there. You have hospitals, Nike's, based in Portland, they have a presence throughout the state. Again, Tacoma, SeaTac, Sacramento's interesting, and I'll tell you about the Sacramento. Sacramento, in my mind, it's a little misleading here. I know there is an upside within Sacramento, but Sacramento went so far down. They went so far down when the crash that the upward movement, and also it's the state capital. It's the state capital, and I tell people that is that from an investment standpoint, one of the formulas that I've seen people use in the past is that within an area or a city that has both the state capital and the state university, because the state is very vested then in that city, and they're not going to let it go down.
Mm-hmm. Mm-hmm. Let's go on to rent and vacancy. Again, not a surprise here, considering the time horizon and the fact that occupancy rates are as high as they are, and rents have continued to go on up from there. If we move on to affordability, it's kind of the same story we talked about before. As you look at this by the markets, it's really no surprise based on where affordability is an issue based on the share of income that's spent on the rental payment. The larger, denser cities obviously have that. Sales volume and price on the next one, though, that's kind of interesting because all of a sudden in 2017 and looking into 2018, what's your expectation for what you think is going to happen next?
I think you're going to level off, meaning that I look at this chart and it equates to what we have seen with our own financing, that there was a period of time where we mostly just did refinances. And then, we hit more of that 50-50. And then all of a sudden, you're in this space where I think last year there was a lot of, and the year before, there was a lot of purchases. But now there's less bargains. There's less upside potential that people have to ferret through more to find that deal that they actually want to purchase and move forward. The institutional investors are going to find a stabilized property. They're going to pay what they're going to pay. They're going to be happy with their smaller rate of return. It's a matter of, in our space, and the people that we work with are people that are, in a sense, finding value add, finding, where they can maximize the potential of their dollars. So I think there's less bargains out there, and that's going to lessen the amount of acquisitions. And the other piece is, we'll see as interest rates start going up and cap rates start stabilizing, we'll see what happens. But it's also, again, it's a matter of, I look at some of these deals, I look at what we're doing, and it's digesting where the cap rates are, where the values are, and does it make sense? What's my return? What is my return? How much am I going to get? And right now, if I'm buying at the top of the market, how am I making any money?
Well, in both the under 50 and above 50 unit deals, are you seeing any movement in cap rates? And I was saying the going in cap rate, not the coming out or cap rates after improvements.
You do see. It depends on the level of, if you want to say, improvement. And of course, as we know, the area might lag behind your improvement. I mean, we have some borrowers that go into some rough areas, and they really do a great job on stabilizing that asset, but they don't control the neighborhood. So really what's happening is that they're maximizing their own return, meaning that they've decreased their costs, they've increased their rent. They've increased their rents because we know in some of these neighborhoods that word of mouth gets around, and you move to this property, it's a good property. They're on top of it. That they're not going to mess around. That if someone's getting to be a problem, they're going to go. That they're going to make sure that the asset is in a sense secure. And what happens is I tell people is you're more of a situation where you're clipping a coupon. That I know what my cash flow is, and I'm sitting back. I'm at a very low interest rate. And I'm able to clip that coupon.
Okay, let's go on to completions. These are 5-unit structures and more, so it obviously includes an awful lot. But I think if we were to look at completions for under 50 units, it would be a different picture. There are very few things being permitted under 50 units in most places, and to the extent that they are being permitted, they're being built at a pretty high cost, at dense infill, and not so much on the affordable side, a little further out. One of the interesting parts of the slide is if you look at the percentage of total housing completions, you see that it's jumping up pretty high. And that's unusual, but that's not a trend that's going to continue overall. And then value add. I love talking about value add. This is multifamily bridge and mezz origination volume. What do we take from this?
As far as, you can see that we sort of leveled off into the quarters, but there was a big jump in 16. Number of loans that were related to that, and versus origination volume, meaning that with the origination volume, of course, is that years back you had greater origination versus the fact of the number of loans.
Do you think we've reached a plateau?
As I said before, there's less bargains out there. I'm seeing fewer and fewer what I would consider bridge opportunities, but they are out there. And the one thing is that what we talk about within the small loan space. I would say from an opportunity standpoint, under $5 million, trying to find a bridge under $5 million is very difficult. And if you do, there's a high cost associated with it. And it's typically because of the cost of the lender, through the legal fees and everything else, versus the amount of the loan. And again, it's something that we as a firm are looking at intently, to try and create some level of a product, some level of if you want to say, it's whether it's with partnering or somebody else, or if we can bundle and figure that out, because I would say that's probably one of the bigger holes within the market from an institutional standpoint, are those bridge loans under $5 million.
Okay. The next couple of slides are really included in the pack for reference. We're going to skip through those and jump into technology in the small multifamily loan space. This is one of the coolest things I think I've ever seen in this space. And so, gentlemen, why don't you explain a little bit more about Alex and some of the things.
Vince is younger than I am, so he's probably more tech savvy.
Well, I'm in the old days where technology was a pencil, so and when they had pencil that went from number 2 to number 3 lead where it didn't wear down as much, I thought that was the coolest thing I'd ever seen. So this is really showing my age, but also very cool for what you can do. So, Vincent?
Sure. Yeah, I'll touch on the technology in the multifamily loan space. There's been a major push to streamline the loan process on the residential side of the business. The commercial side has generally been a bit slow to adopt this technology. I'm sure you've seen on TV Quicken Loans commercials for their Rocket Mortgage platform. Arbor's made a concerted effort to stay ahead of the curve in this aspect. In fact, we were the first agency lender to create an online platform with Arbor Loan Express, or ALEX for short. In early 2016, we launched ALEX to the public, the first online agency lending platform for multifamily borrowers. Here we see the landing page. You can get started on here by requesting your quote, or you can hop on our live chat feature during business hours and connect with an originator. You might find me on there. So borrowers can simply enter their requested loan amount for refi or acquisition, then upload a diligence package with some of the things we listed earlier: rent roll, operating statements, personal financial statement, etc. If you submit this during business hours early enough, we'll get back to you same day with some preliminary feedback about the viability of the deal. If not, we'll get back to you the next day. So once we spread the numbers and confirm that there's a deal here and it's viable, we'll issue an application. This application can be e-signed. As one of the main reasons for developing ALEX was to eliminate the need to print, sign, scan, and email the documents back to us. So all of the paperwork online is e-signature capable. So after an application is signed and returned, we move into the processing stage. And this is where I think ALEX really shines. So users are able to upload documents and see exactly what they need to submit to keep the deal moving forward. Here you'll see the platform here. You'll also get email alerts for any missing documents or questions from the underwriter. Really helpful stuff during the loan process. One of the pains for many borrowers is, especially first-time agency borrowers, is the fair amount of paperwork that's required. However, with ALEX, we've streamlined this process and created complete transparency every step of the way to keep you guys informed. And it's not just the borrowers who can benefit from ALEX. Mortgage brokers have said it's easy to navigate, upload docs, and just provide a better loan status update to their clients and help them communicate overall. So here's a quick recap of ALEX's major benefits over the old-fashioned way: e-signature, streamlined documentation, real-time diligence tracking. I'll let you know exactly what you need to submit in order to keep the ball rolling. And with that, I'll pass it back to Charles for Q&A.
Sure. I mean, one of the things, as Vince brought up with ALEX, is just that, it's real time. And with the dashboard, you know what you've sent to us, we know what we sent. It's not back in the days of trying to either email information, fax information, or send a big packet. It's great for uploading and knowing where you are or at any given time. I think there was some level of questions that we've been getting. I guess one is worried about hyper supply. I think I touched upon it. It's market to market. I would say certain markets like Washington, D.C., depending upon where you're coming in at the rent, might concern me. Miami might be concerned because I couple that with foreign investment. New York, Brooklyn especially, it could necessarily, but again, it's going to be a market-by-market approach. I think I might have had the same issue as it related to Houston, but with the unfortunate incident, some of the early numbers that we have seen is that there's 60,000 apartment units that are offline, and I believe 200,000 homes that have been affected from the storm.
Roughly 15 markets out of the whole U.S. account for about half the new building.
Mm-hmm.
So the vast majority of the other markets are exactly as you suggested.
Sure. And, so the next would be how to invest out of state. Well, investing is, I'm not sure what you mean by investing. Do you want to own? Do you want to, in a sense, invest with someone else who's the lead? Or are you looking to purchase? If you're looking to purchase out of state, you don't have any experience, again, we mapped it out that you should probably find somebody who is local, who has roots, that understands what's going on. Other than that, I'm not going to recommend anything, aside from, this is, I guess, the public service announcement, a plug that Arbor itself does have a crowdfunding platform. The interesting thing about our crowdfunding platform is that we are a multifamily lender. There are segments within our company that actually also do own real estate, but what that means is that anybody we're crowdfunding with is somebody we've done business with before, somebody we know, somebody we've vetted, somebody that we've already done the due diligence on. So there's that route from a crowdfunding source. I'm not telling you to go out and invest in Arbor Crowd. I'm just making it as an example. Other than that, as I said, it's a matter of research and where you can go. Will a condo market accelerate? I think if you look at the housing market, I put the condo market in the same way as the housing market. I think, from a perspective of building condos, again, it's going to be what market that you're in, where you're at. I don't think you're back in the days of, I remember, everybody was converting every apartment building to a condo or a co-op, and then more of those failed than you can imagine. But again, everybody was afraid of the condo market for a while as far as the shadow inventory. I think that's gone, and if anything, you look at, now these single-family home purchases. Another question, 7/6 ARM, is it assumable? Loans are typically assumable. There's a couple of caveats, meaning that depending upon who's assuming it, they have to be underwritten. So if they're not an acceptable borrower, then no, it would not be assumable. Do we have any other questions coming through? Minimum down payment required. We're only going to leverage up to 80%, max 80%. Some markets are going to be a little more restrictive, meaning a small market or a very small market. Do you do construction lending? I wish we did do construction lending because it would make my life a lot easier. Can I expect an application saying that, Vince, you would be better at if somebody has a package that they want to send us or they want us to review, and if we find it, within the box, how fast could they get an application in front of them?
If it comes in and it has everything we need, we'll get you preliminary feedback that same day with our initial sizing, where we're shaking out. I would say max 48 hours for an application.
I'm trying to read through this stuff as fast as I can. Michael Ratliff, you're going to be the go-to as far as post webinar?
Yeah, that's right. We'll be following up with anyone who has a question we can't get to, and we'll also be sending this out along with the presentation as well as the recording of the webinar to everyone who's registered as well.
Okay. We've actually been at this, it's been an hour? It's been an hour. So we're going to end up, and just because I said everyone does have busy days, I appreciate everyone's time who is on the other line. Again, we will get to your questions. We have them in front of us. You already gave your info, Michael, or you didn't give your info?
You can email either mratliff, that's MRATLIFF, at arbor.com, or just email at arbor.com.
And as I said, we will get to all your questions. I thank everybody for joining us today. And typically, Arbor does have one webinar a month. If you're interested in other topics or subjects, please reach out.